A new all-time high and then 19,000 as well. Today has been an eventful day for the markets. Over 20 days after the Nifty Bank made a new high, the benchmark Nifty has done the same now. New life highs on any index have an almost mystical quality about them. I guess that's because they tempt us to think, how much higher can we go? I'm Prashant Nair, and with me is my colleague Mangalam Malu, who's standing by on the big wall. Mangalam, hi. We also have top experts joining us on this edition of Bulls Charge Ahead to answer the question of how much higher can markets head. Samir Arora is with us, and so is Mark Matthews. Gentlemen, thanks very much for joining us. But before I come to the both of you, let's actually hear it from Mangalam, who's on the wall. Who are the big movers of this rally? Mangalam, over to you.
Well, you know, it's such a stroke of fate, right, that the Nifty has gone ahead and hit a fresh record high on a day where we weren't even supposed to trade. There was a holiday which was declared today, and thereafter until last noon, we didn't even know whether we were trading today or not. And after going to within 1 point of record high last week, the Nifty has managed to hit a record high today on a day where we weren't supposed to trade. So that's fate, so to say. 4% higher and 4.5% higher for the Sensex or the frontline indices this year. So far, the Nifty Bank has been a relative underperformer with a gain of just about 2.5%. But this rally is more loved by portfolios because small cap and mid cap indices have put behind them double-digit gains in this year itself. And if you take a look at the sectors as well, the domestic themes have done a lot better. Realty, 19% higher. FMCG, auto, up 17%. And the global-facing ones have actually underperformed. So the IT index down almost 1%, the metals down 9% as well. And this is clearly the reason why we did well. Indian macros did better than global concerns. Secondly, what we did was domestic themes doing extremely well with hopes of margin recovery in the second half as inflation cools off. And that really is because of stable crude and cooling inflation, or the worst of inflation being behind us. What also helped us is FII flows picking up, particularly in April, May and June so far as well, where we've seen about $1 billion coming in from the FIIs. Higher emerging market flows coming into India versus China explains why we've done well as well. So let's talk about the stocks then. Tata Motors up almost 50% this year. ITC 35%. Bajaj Auto, again, a domestic play, has done well. The ones which haven't are Infosys, Hindalco, Adani Group, of course, had a rough last few months as well. Just keep an eye out on a bunch of these mid-caps which have done well. Over the last few trading sessions, the pharma stocks have come back into fashion. So the mid-cap gainers are led by Aurobindo Pharma, Glenmark Pharma. Then a couple of these manufacturing themes, ABB doing well. Defense, HAL up 45% this year so far as well. Then you had some valuation concerns for AB Fashion. That stock has been underperforming. Z, Indiabulls Housing, ACC again under pressure largely because of their own news, specific news. But the big movers have really been in the small caps. Balu Fortune, I had to cut off this data for stocks which have gained only up to 80% this year so far. This one's up twice of that, 160% higher. Titagarh Rail, again, 125% higher. Zentech, JBM Auto. Look at some other rail players as well, and you'll see RVNL up 81%. Mrs. Vectors has actually done extremely well as well, 95% higher this year so far. So going forward, what are the things that we're looking at? Well, the Nifty is trading at 19 times, fairly valuing the earnings upside in the near term. So let's watch out for the triggers going forward. Global growth and interest rates concern something that we will keep an eye out on forever. Flows into other emerging markets versus India, because so far India has gained 4%, Brazil's done better, Shanghai has gained as much as India. So going forward, how does that pan out? Monsoon's been a little delayed. There has been a slight deficit. So demand recovery in the second half is something that we'll be watching out for. And finally, just keep an eye out on state elections in India. There are 3 states going into elections, all of them building up to the next central election in 2024.
Mangalam, thanks very much for that. That's an exhaustive sort of list of what's done well and how strong this rally has been. Well, Samir and Mark are waiting by. Gentlemen, great to have both of you here. Once again, appreciate your time. Samir, let me start with you. I mean, you're no great fan of new highs, I know that, over the years. But what does it mean to you, really? I mean, new all-time highs.
So why I'm not a fan is because in theory, the markets are supposed to be at all-time high every day if they were not volatile. It's like a fixed deposit where every day interest is getting accrued. So the way to look at it is that when was this number crossed, which calls it an all-time high, which was 2 years ago, which means from last 2 years, the returns are like flat. And currently, even in US dollar terms, the returns are not, the index is not all-time high. So I would say it is just a good start. But you should look at the last X number of years annualized returns, let's say last 5 years. and they are in the same range as the last 10 years and then same range as the last 15 and 20 years, which is in the range of 13, 14, 15% per annum. And therefore, it is all continuous, regular, this thing which is doing well. And this number we can celebrate, but we should not take our eye off the ball.
Not take our eye off the ball. Samir, thank you so much for joining in. Usually you're surrounded by books. Today I see a Ganesha behind you. You say, let this be the start of something good. What do you reckon that start is, and where do we go from here?
So I'm saying that broadly, if you look at the last, any longer term period, our returns in India in rupee terms at the index level have been in this range of 13, 14, 15%, which is consistent with various other things you can relate to, whether GDP in nominal terms or corporate earnings in general growth for a large part, or you could say equity risk premium over US government bonds. All of that would lead to this kind of a number. And today we can say that when we have achieved these 13, 15% index level returns in the past, today our relative situation of India versus other big pools of money, whether US or China or Europe, India looks better. And therefore, we should expect this or more kind of returns in the medium to long term. Now, you can say that since today is a high, maybe next month is not good, but in general, you should get these kind of annualized numbers going forward when we have been able to achieve them in the past without ever feeling that these are not in line with reasonableness, which is, as I said, these 3-4 things, whether you look at GDP or corporate earnings or equity risk premium over fixed income returns. So broadly, this kind of returns can be easily or more confidently expected in the future. And this is better than anything else you will get in any other liquid, reasonably easy to get in, get out kind of investments. And so it's very...
And that last part, easy to get in, easy to get out, has been so amply demonstrated, right? I mean, with all the... Actually, last 2 months, we've had 55,000 crores worth of blocks, even as the market has made new highs. It is incredible, right? And we'll come back to that in just a bit. Let me get in Mark Matthews also into the conversation. Mark, great to have you with us here. You've been sort of table-thumping, chest-thumping bull on India. Absolutely clear-eyed about where, what the prospects for the market here are. And it's been good to speak with you over the last many months. Where now that the Nifty is at 19,000, new highs?
Just to clarify, I wasn't always a bull on India, although I regret that. I should have been. And I am now, and I think it can go higher. And don't worry, it won't take long, but there's 4 reasons. 2 are domestic and 2 are overseas. And the one that I'd start with is that the government has laid foundations that are now being built on for a very strong economy. And I won't go into details because we all know them, from demonetization to the various acts that were passed to help sectors like real estate. Then the second thing I would say is that the corporate sector's balance sheet, by and large, is delevered, and PSU banks' NPAs have been taken care of. That's the domestic side. On the foreign side, China was the market in Asia which everybody wanted to be in. It isn't anymore. I don't think it will be for a very long time. And that takes an enormous market away. And what can it be replaced with? Well, yes, people are talking about Japan, and for good reason. I wouldn't be critical of Japan, but the fact is that they're very old. And we know that they're going to get a lot older. And then the last thing is that MSCI is talking about moving Korea from emerging to developed index. And that would probably result in about $35 billion of flows moving into the other emerging markets. I put those 4 things together, and I think India can go higher.
Samir, do you get a sense that, Mark, a great sort of summary of why you think markets can go a great deal higher? Samir, do you sense that foreigners are a lot more bullish, a lot more, if I can use that word, quote-unquote, clear-eyed about the direction for India? And you can sense this, right? When you read the Financial Times, you read the Economist, you read foreign press, it's that kind of, if I can use the phrase, India's time is here. You don't sense that euphoria in markets yet. I don't think so. Maybe in some pockets, but that's always true in any phase. Generally, overall, that euphoria is not there, which is there for India as a manufacturing hub, etc. Your take, Samir?
But I think this is the biggest. If there's one line story, it is this China plus one story playing out both on the corporate side or the supply chain kind of thing, and also the FII side. So on the FII side, it is clear that emerging markets index has some 29-30% in China, and there are so many big voices saying that they either want to cap their investment in China, or last week in Financial Times there was an article that they are looking for Asia ex-China benchmarks. And actually there was one headline which says investors want to cancel China. And so the thing is that if even that 29% they reduce it, maybe with just new money not being there, to 24, 25, 20%, which means that they're not stopping there. But that biggest beneficiary of that flow to other markets would be India, because it's the most natural competition to China. It most probably will not be Taiwan. And for this Korea thing, the only angle I have is that maybe then investors will find that emerging markets itself is not a big enough group. So you invest in Asia, you invest in China separately, India separately, and maybe just put something in the rest of emerging markets. Because if Korea's moved to developed markets, in theory, if its weightage was 14%, then people should allocate that 14% to developed markets if they thought that 14% of their emerging market allocation should was going to China, to Korea. But my thinking is that the emerging market itself will lose some sheen, because it'll basically be India, China, and so you might as well directly put in these two, which will be of huge positive benefit to India. And also what the government has done and what other things have happened have made it credible for those investors to feel that they are not doing it only on a flow basis, that just because they are frustrated with China, they are not putting into India. Separately, India has done ABC and our infra is improving, and we have a good digitalization of the economy, and our demographics are good, and we have some good policies for attracting foreign investment or PLI. So you also need to do that, which we have done. And therefore, it should not, the investors or the FDI guys should not feel that they are doing it solely out of to avoid China. And this combo is, I think, very good for India. The combo that we are ourselves proving to be attractive, and secondly, that we have this flow kind of benefit on both the sides.
Well, stay on with us on that point. We have to take a very quick commercial break, but we are back with a lot more questions for both Samir and Mark Matthews.